Welcome. Today we're demystifying one of Wall Street's most popular, yet often misunderstood, financial metrics, EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a mouthful, but it's critical. Investors love it because it provides a clear view of a company's core operational performance by stripping away non-operating factors. It starts with E for earnings. This is the net income, the profit left over after all expenses have been paid. But we want to look at those earnings before certain items are taken out. Let's break down what we add back. First, I for interest. This is the cost a company pays to borrow money. Since debt levels vary, we add this back to compare companies fairly. Next is T for taxes. Tax rates change based on where a company is located, so stripping them out helps focus on the business itself. Then there's D for depreciation. This accounts for the wear and tear of physical assets, like machinery or vehicles, over time. Finally, A for amortization. This is similar to depreciation but applies to intangible assets, like patents or software licenses. By adding these four items back to net income, we get a metric that often serves as a proxy for the cash the business generates. So, why does Wall Street love it so much? The main reason is comparability. It levels the playing field. It allows analysts to compare a highly leveraged company in the US to a debt-free company in Europe on equal footing. It's also a staple for valuation. Investors often use the EV to EBITDA multiple to determine if a stock is cheap or expensive. Let's look at a worked example. Meet TechCorp, a software firm with $10 million in annual revenue. Their top-line revenue is $10 million. After paying for staff, servers, and marketing, their operating profit is $4 million. Now, after TechCorp pays $500,000 in interest and $1.5 million in taxes, their final net income is $2 million. To find EBITDA, we start at that $2 million net income. First, we add back the $500,000 in interest. Then, we add back the $1.5 million they paid in taxes. Now we're back at that $4 million operating level. But TechCorp also had $1 million in non-cash depreciation from their data centers. We add that back too. The result? TechCorp has an EBITDA of $5 million, significantly higher than their $2 million net income. This gives them a 50% EBITDA margin, showing just how much cash the core business is capable of producing. However, it's not perfect. Famous investors like Warren Buffett warn that it ignores the real cost of replacing equipment. For capital-intensive businesses like airlines or manufacturing, ignoring depreciation can be a dangerous mistake. Lenders also use it to see if a company can cover its debt. But if EBITDA is high while cash is low, trouble might be brewing. The key is to use EBITDA as part of a larger toolkit. Never look at it in isolation without checking the actual cash flow. To recap, EBITDA highlights core performance, levels the playing field for comparison, and acts as a quick cash flow proxy. When you see a high EBITDA, always ask, how much is being spent on equipment? And what is the actual cash left in the bank? For more financial deep dives and insights for the modern finance professional, visit us at the CFO Suite. Thanks for watching. Now you're ready to talk EBITDA like a Wall Street pro. We'll see you next time.